Today I'm going to show you how to screen for Singapore stock ideas using one simple strategy that will narrow down the 700 plus stocks in the Singapore exchange to just 15 of them. And out of these 15, you can do more homework on them, or you can also stick around in this video as I touch base on 5 companies I've pre-selected. With that, let's dive in. Whenever we talk about the criteria for filtering out stocks that you like, people tend to go for the common ratios like PE ratio, PB ratio, dividend yield, etc. But today, let me show you a simple trick. Okay, instead of using the common ratios, which you have to then do a lot of research or work analyzing the financials later on, I simply go for the analyst consensus criteria, which can be found in the Share Investor Web Pro platform. If you are keen to find out more, I've put down the link in the description below. So, okay, next you can see from this screenshot that we have our 3 criteria layout. Number 1 is the number of analyst ratings. We selected more than 5 because we want the particular stocks to be readily covered from different angles, because more analysts translate to more homework, more due diligence being done, right? The next one is the price upside from consensus. We selected a range between 30% to 100%. We don't want anything more than 100% because that will be too far-fetched. And for quick background, we are talking about the analyst 1 year price target here, right? So since we have already set a minimum average of 30% potential upside, it would really bring the spotlight to the list of stocks. That means we are talking about within 1 year, these stocks can have the potential upside of more than 30%. So that will also mean that they have some kind of catalyst of growth prospects, which are making the analysts so bullish on them. The third and the last criteria is the market cap. So we simply base off this that we don't want to go for smaller or micro stocks because they usually depend more on their sexy story or just the upward burst all of a sudden. All right. Uh, that is dependent on the market sentiment rather than on the financial or fundamental data from the analyst. With that, once you click on the screen button, so you click on the screen, you wait for a while, and ta-da! Here's the results. From this list of stocks, we're gonna cherry pick 5 Singapore companies that we are gonna briefly talk about their analyst consensus trend and the forward estimates I find interesting. Okay, let's take a look at CapitaLand Invest. All right. So the current share price is $3.04, and the analyst has a recommendation of buy with an average target price of $4. So that translates to around 32% potential upside. Okay, so this is based off 14 analyst ratings. All right. And moving on, you can see from here that this is a 2 year period, right? From October 2021 to October 2023. And majority of the analyst recommendations are usually bright green, which is buy. Okay, and you can see the share price movement in this blue color line over here. And based off 1st of February, where there's very little margin of safety, only 3%, 3.7% deviation from the actual price versus the target price. But as of now, at the time of doing this video, right, the difference has widened to like 30 something percent. So this is um showing that, okay, so even though the share price has came down by quite a bit from around $4 to $3 plus, okay, the analysts are still keeping their or just minor adjustment downwards for the analyst target price. And next, let's look at their forward estimates from the analysts. All right, so you can look at these light blue color columns. We can see that the analysts are saying that the revenue will be increasing into 2025 as well. Net earnings also going to increase from 779 million in June 2023, trailing 12 months, to around 1.2 billion come 2025. Okay, so on top of that, all right, the dividend per share is also going to increase to around 15 cents. So based on the current share price, the dividend yield will be increasing, all right, from around 3.9% to 4.9%. That is if you are purchasing the shares right now at the current beaten down share price of $3.04. Okay, so now let's move on to the next stock. Before we move on to the next one, don't forget to like, subscribe, and ring the notification bell so you never miss an update again. As usual, to show my appreciation, here's a financial meme for you. Okay, the next stock on our list is Dairy Farm International Retail Group. Okay, so based on this website over here, you can see that they are present in the Asia region. All right, coming from like Hong Kong, Macau, Singapore, Indonesia, and more. Right, so they have a lot of retail outlets or the brands that we are familiar with, such as like IKEA, Guardian, Cold Storage, okay, and 7-Eleven in Singapore itself. All right, so let's talk about their analyst consensus estimate. Okay, at the time of recording, it is trading at $2.26. Okay, and the analysts are giving a buy recommendation with an average target price of $3.30. Okay, this is based on 8 analyst ratings, and that translates to a potential upside of 46%. So that's pretty high in that aspect. Okay, moving on, let's look at the 2-year analyst trend, right? So if you were to look at the brown color line, you can see that you can say that the analysts are kind of flip flop lah, right? They downgrade the target price, from around $4, okay, to $2.50, and now they are shifting it back up to $3.30. Um, that in a way, right, if you were to look at it, they are so-called factoring in that all the cost-cutting measures are being done, and dairy farm group is on the way to recovery, and that's why they started to increase the target price again. Because if you were to look at it, although the share price came down sharply to $2 and maybe $2, all right, as of October 2022, so 1 year ago, it has rebounded but came down again, maybe due to the macroeconomic environment, whereby right now there's high inflation and high interest rates and things like that, right? But all in all, what I want to share with you is that there is a significant gap over here. So what I can see is that they usually will stick close to each other, right? The actual share price and the target price will tend to converge together. And since then, right now there is a potential gap that we may be able to take advantage of. Okay, and next, let's look at their forward estimates. So you can see here that although the revenue has been quite stable in the past 3 years, analysts are thinking that it will increase gradually to around 10 billion in 2025. So it's not a lot, because it has already come from a very big base, but it is still on a gradual upward trend. And the better thing, or the positive bright side is that their net earnings is actually going from a negative, a loss making, to a positive number going forward. So that is what I say by they are factoring a rebound in the numbers after all the cost cutting measures. And moving on, all right, you can also see that the net debt of Dairy Farm Group will be coming down sharply based on what the analysts predict. Okay, so from 3.8 billion to 2.8 billion and maybe to 1 plus billion going forward. So with that in mind, okay, their dividend yield may be increasing going forward. So right now is 2.21%. Pretty okay, I would say decent, given that it is a blue chip stock. All right, but it is not high enough when you look at banks out there giving 5-6% dividend yield. But going forward, after you know maybe they have streamlined their business segments, their operations. Going forward, they may be able to pay better dividends for Dairy Farm Group. Okay, so one thing to watch out is especially the transition from losses to net profits as well as the net profit margin, because for a retailer business, the profit margin tend to be quite low. So it is important to see whether they can stack up the margins going forward. All right. So now let's move on to the third stock. Okay, so if you look at Genting Singapore, you would realize that if you type in the phrase Genting Singapore, you will not see their website. Instead, you must type RW Sentosa. Okay, because this whole integrated resort is the entire business of Genting Singapore. But of course, it's not just one resort lah. You have hotels, you have Universal Studios, Sea Aquarium, Adventure Cove, the food, and more, a lot more. Okay, even the events and promotions and things. So I believe a lot of us already know what Genting Singapore is about. So let's move on to the analyst consensus estimates. So as of the latest share price, it is trading at 83 cents with an average price target of $1.14, overweight recommendation by 16 analysts. So you can see that Genting Singapore has many more analysts covering it than like maybe Dairy Farm, because maybe I would say that maybe Genting Singapore is more interesting. It's easier to analyze as well as compared to um, the dairy farm, which has a lot more outlets, so many different segments, right? Genting Singapore only one business in Sentosa. Okay, anyway, we have above a potential upside of more than 37%. Okay, so that's quite incredible. And looking at the consensus trend, I would say that okay, Genting Singapore has always traded at very subdued prices. So it has been trading range bound from 73 cents to around 80 something cents from 2021 to 2022. And at the start of the year, right, or rather November 2022, it suddenly shoot up all the way to around $1.20. Okay, that's where the actual share price caught up with the analyst price target. Okay, but subsequently the share price came down a lot as well. Maybe because a lot of investors think that, oh, the rebound is coming, um, China is opening up again and tourists are coming back. But after a few months or so, they realize that no, China is facing their own problems. The numbers have not really been as favorable as we have expected, and hence the share price came down sharply again. Okay, they fall back from $1.20 to around 80 something cents right now. So that is um, offering us a rather big kind of a gap, more than a 30% upside from the analyst price target. Okay, and actually, if you were to look at my previous videos, I've talked about Genting Singapore before, and there are a lot of exciting developments ongoing, like the Minion Land. They have invited the Super Mario. So they are also doing a lot of renovation work to incorporate other kind of exhibitions. So going forward, I believe that it will be quite exciting for Genting Singapore, as depicted, right, maybe by the analysts here, that the revenue will increase from around 2.1 billion to 2.8 billion in 2025. Net earnings will also grow steadily from 500 plus million to 700 plus million. But on top of that, right, I think the best part is that, um, okay, it is also a dividend paying stock. Okay, right now it's already giving us around 4% yield, and it's going to increase to around 5% in the next 3 years. So for Raffles Medical Group, if you want more information, you can check out their website. But other than the usual clinics that we see, they offer a wide range of healthcare solutions like primary care, specialist centers, and also their famous Raffles Hospital. Okay, now moving on to the analyst consensus, right? For Raffles Medical, you can see that right now they're trading at $1.20. But analysts are saying that they are giving a target price of $1.67 and a buy recommendation. So based on seven analysts, it is giving a potential upside of 39%. Okay, moving on to the 2 year analyst consensus trend, their history. You can see from the 2 years ago, it was the share price is actually trading at $1.40, much pretty much close to the analyst target price. But since then, the analyst price target has moved up gradually to $1.67, while the share price has gone down to $1.22. So there is around a 45 cents difference, which translate to a 37% potential upside. As to why Raffles Medical share price has, not seen a uptick, all right, in the past 2 years, it may be explained by the forward estimates from the analysts. Because when you look at the revenue trend over here, analysts are saying that the revenue will still stay, constant or rather stable. Okay, from 700 plus million to only 817 million by the time 2025. So that is very slow growth, I would say. Okay, and the earnings, all right, the analysts are also predicting that the earnings are going to come down in the 3 years going forward. So that is not really a positive sign over there. It's mainly saying that, because of their expansion in China, the the environment in China is maybe not so upbeat. All right, as a result, the earnings for Raffles Medical is going to be reliant pretty much on the Singapore operations. And on top of that, you need to factor in the ongoing costs that are incurred by the China operations. Okay, but that being said, right, Raffles Medical is in a very stable financial position or strong financial position, because there is a it is a in a net cash, okay, balance sheet, and they are churning out free cash flow on a year to year basis. Right, so the last stock on our list is Citrum, previously known as Samcorp Marine. Okay, since then it has merged with Keppel Offshore and Marine to form a consolidated player, and they are able to secure a lot of new order books as shown in the latest presentation slides here. All right, so they have a strong order wins of 4.3 billion in just the first half 2023. So total order book is, I think, at the time of the video, they have already exceeded 20 billion. Okay, and renewables and clean solutions already form 40% of their net order book. They have also done delivery of many key projects in the past, 6 months or so. Although it is a net loss of 264 million, all right, analysts are pretty much upbeat on their growth prospects going forward after the merger happened. So if we were to look at the analyst consensus again, right now Citrum is trading at around 12 cents. Okay, analysts are giving an overweight recommendation with an average target price of around 18 cents. So there's a 6 cents difference, and that would translate to around a 50% upside. Okay, so this is based on 9 analyst ratings. So I would say that these 9 analysts would have done their homework, all right, given the maybe their different expertise in the oil and gas sector, all right, or offshore and marine sectors. Okay, and looking at the 2 year consensus estimate history, you can see that the share price and the analyst target price have been increasing in tandem. All right. So 2 years ago, I think it was facing a lot of difficulties as they are losing money. Oil prices are very low, and they are unable to make sense out of their business operations. But since then, all right, I think things are looking up for Samcorp Marine. Oh, sorry, Citrum again. And after they sort of deep into the 10 cents region, they have rebounded again, and right now they have sort of like maybe there's some profit taking going on, so it's sitting at around 12 cents. Okay, so I believe that this is giving the biggest, okay, gap or potential upside as of now. Because if you were to see, the analysts are always keeping tab on Citrum and constantly increasing their target prices. So this is something that you can take note of. And moving on to their forward estimates, wow, you can see that analysts are really bullish on Citrum. So from 1.8 billion to 3.7 billion in revenue, analysts are predicting that it will jump, like by a wide margin, like 30 something percent, then 50%, and then another 20 plus percent. So it will end off more than 100% jump in the revenue when you consider it going into December 2025. All right, and eventually, okay, analysts are also thinking that although it is loss making in the previous 3 years, they are going to turn around in 2024, and then the profits are going to stack up by 2025 with around, I would say, if you look at the net profit margin, okay, it will become a 5.6% margin come 2025. Okay, and of course, this is a rather turnaround stock, so you won't be looking at dividend yield lah for Citrum. Okay, what you need to look out for is just the earnings and the revenue growth, which analysts are really bullish about. And on top of that, what we need to take note of is the net debt. All right, you don't want the borrowings to grow too much out of control. But just by looking at it, all right, analysts are saying that they will be, positive that the company will reduce their borrowings going forward. So all in all, I think the analysts are bullish on Citron. Okay, given that maybe they are focused on renewable sector, or that maybe the worst is over, and since oil prices are going up again, Citrum is well poised to ride on this recovery going forward. Next, if you're keen to also check out the US stocks with over 30% potential upside in our next video, then you need to subscribe to my YouTube channel and click on the bell to receive the notification in future. With that, I hope that you have find this video helpful and I will see you in the next one. Thanks for watching and ciao.